Imagine you're driving a powerful sports car called the U.S. economy. It's fast, responsive, and capable of incredible acceleration, but it can also overheat, skid on sharp turns, or stall unexpectedly. To keep it running smoothly at the right speed, two drivers sit in the front seats. One controls the gas pedal and brakes through spending and taxes. That's fiscal policy. The other fine-tunes the engine's fuel mixture and air intake via interest rates and money supply. That's monetary policy. Both aim to keep the car cruising at a steady, sustainable speed. Strong growth without inflation spinning out of control or a recession slamming on the brakes. But they operate differently, with different tools, timelines, and personalities. Let's start with fiscal policy, the government's direct hand on the wheel. Picture the government as a massive household with a huge budget. Fiscal policy is how it decides to spend more, building roads, funding schools, sending stimulus checks, or spend less, and whether to raise taxes, taking more money from households and businesses, or cut taxes, leaving more in pockets. When the economy slows, like during a recession or after a shock, the government can hit the expansionary accelerator. Cut taxes, people and companies keep more money, they spend and invest more, demand rises, businesses hire, growth accelerates. Increase spending directly injects money into the economy. Infrastructure projects create jobs immediately. Unemployment benefits help families keep spending. The classic modern example? The massive stimulus packages during the COVID pandemic. Trillions in relief checks, enhanced unemployment benefits, and business support programs flooded the economy with cash when everything froze. It was aggressive expansionary fiscal policy that helped prevent a deeper depression and fueled a rapid rebound. But when the economy overheats, too much demand chasing too few goods, driving up prices, the government applies the contractionary brake. Raise taxes, less disposable income, reduced spending. Cut spending, fewer government projects and transfers, less overall demand. This cools inflation but risks slowing growth too much if mistimed. Fiscal policy packs a punch because it directly affects household incomes, public services, and entire industries. It shapes everything from new highways to healthcare access. Yet here's the catch. Fiscal decisions go through a noisy political process. Congress debates, compromises, and sometimes gridlocks. Legislation can take months or years to pass and implement. By the time the money flows, the economic road conditions may have changed, making the policy arrive too late, too weak, or even counterproductive. Now shift to the passenger seat, monetary policy, handled by the Federal Reserve, the Fed, the independent central bank. The Fed doesn't spend tax dollars or write laws. Instead, it controls the cost and availability of money itself. Its primary tool? The federal funds rate, the overnight interest rate banks charge each other. This ripples outward to influence mortgage rates, car loans, credit cards, and business borrowing costs. When growth needs a boost, expansionary monetary policy, the Fed lowers interest rates. Borrowing becomes cheaper, consumers buy homes and cars, businesses expand and hire, spending and investment rise. When inflation threatens to spiral, contractionary monetary policy, the Fed raises rates. Credit gets expensive, people and companies cut back on big purchases and investments, demand cools, price pressures ease. The Fed also uses open market operations, buying government securities to pump money into the system, increasing liquidity and lowering rates, or selling them to pull money out. Another powerful lever in crises, quantitative easing, large-scale asset purchases when rates hit near zero. Look at recent history for a clear picture. After ultra-low rates and massive bond buying during the pandemic helped recovery, inflation surged in 2021-2022, supply chain snarls plus strong demand. The Fed responded decisively, From near zero in early 2022, it hiked rates aggressively through 2023, peaking around 5.25 to 5.50% in 2023. The goal wasn't to crash the economy, just to cool demand enough to bring inflation back toward the 2% target. By late 2024 into 2025, with inflation moderating but still somewhat elevated, the Fed began easing, cutting rates cumulatively by about 1.75% across several meetings in 2024-2025, including 50 bips in September 2024, then 25 bips steps, bringing the range down to around 3.50 to 3.75% by early 2026. It paused further cuts in January 2026 to assess incoming data, balancing risks to employment and price stability amid solid growth but lingering inflation concerns. The Fed acts faster than fiscal policy. No congressional votes needed. The FOMC meets roughly every 6 weeks, analyzes fresh data, and adjusts. This speed makes monetary policy the go-to for quick corrections. But it isn't magic. Lower rates can fuel asset bubbles if overdone. Higher rates can tip the economy into a recession if too aggressive. And in a globalized world, U.S. policy spills over everywhere. So how do these two interact? They often work in tandem, or occasionally at cross purposes. During the pandemic, massive fiscal stimulus, trillions in spending, paired with ultra-loose monetary policy, near-zero rates, and QE, created powerful combined thrust. In 2022-2023, fiscal remained somewhat expansionary, ongoing spending, while the Fed tightened aggressively, showing how monetary can counteract fiscal if inflation demands it. Ideally, they coordinate loosely. Fiscal handles long-term structural issues, infrastructure, inequality. Monetary fine-tunes short-term cycles. In practice, though, politics, timing lags, and differing mandates create tension. Fiscal policy is democratic. Elected officials decide taxes and priorities, but slow and politicized. Monetary policy is technocratic. Independent experts insulated from short-term politics, but unelected and sometimes criticized for that independence. Both aim at the same destination: maximum employment, stable prices, sustainable growth. The economy isn't a simple machine. Shocks, pandemics, wars, oil crises, technological booms throw it off course. Fiscal and monetary policies are the main steering tools we have. Understanding them helps explain why your mortgage rate changes, why stimulus checks arrive or don't, why inflation feels painful, or why jobs appear or vanish. Next time you hear the Fed cut rates or Congress passed a tax bill, remember, 2 drivers, 1 car, constantly adjusting to keep us moving forward, hopefully without too many scary skids. Thanks for riding along. If this helped demystify the invisible forces shaping our wallets and jobs, hit like, subscribe, and drop a comment. What's one policy move, fiscal or monetary, that's affected your life most?